There's a good chance you're paying more in taxes than you need to, not because you're doing anything wrong, but because you're only using one or two of the accounts available to you. Today, we're breaking down the tax-advantaged accounts that quietly protect your money from the IRS, and more importantly, the order you should actually fill them in. A lot of people spend hours researching which fund or stock to buy, but almost no time thinking about which account to put it in. The account you choose can matter just as much as what's inside it, because the right account structure can mean paying less in taxes now, later, or in some cases almost never on your investment growth. Think of these accounts as containers. Same money, same investments, but very different tax outcomes depending on the container you use. If your employer offers a retirement plan like a 401k or similar and matches a portion of your contributions, that match is essentially free money. Before anything else, most people should contribute at least enough to capture the full employer match, because there's no other account on this list that gives you an immediate, guaranteed return like that. Skipping this is often the single most expensive mistake in personal finance. If you have access to a high-deductible health plan, you may also have access to a health savings account, or HSA. This account is unique because it can offer a triple tax advantage. Contributions can reduce your taxable income, the money can grow tax-free, and withdrawals for qualified medical expenses aren't taxed either. Many people treat it like a spending account for this year's medical bills, but used differently. It can also function as a long-term investment account for future healthcare costs in retirement. After capturing your employer match, an individual retirement account, whether traditional or Roth, is often the next stop. A traditional IRA may reduce your taxable income today, with taxes paid later when you withdraw in retirement. A Roth IRA works in reverse. You contribute after-tax dollars now, but qualified withdrawals in retirement are generally tax-free. Which one makes more sense depends on your current tax situation versus what you expect in retirement. And that's a personal decision worth thinking through carefully or discussing with a professional. Once the accounts above are funded, it often makes sense to circle back and contribute more to your employer retirement plan, up to the annual limit allowed. This isn't about the match anymore. It's about taking advantage of the tax-deferred or tax-free growth these plans offer, along with the convenience of automatic contributions straight from your paycheck. If saving for a child's education is a goal, accounts like a 529 plan can offer tax-free growth and tax-free withdrawals when used for qualified education expenses. These are more niche, but if that goal applies to you, it's another container worth understanding rather than defaulting to a regular taxable account. For those who earn too much to contribute directly to certain accounts, there are strategies sometimes referred to as backdoor approaches that can still allow access to tax-advantaged treatment. These strategies involve more nuance and potential tax complications, so they are generally best explored with a tax professional rather than attempted based on a video alone. So here's the general stacking order many financial professionals discuss. First, contribute enough to get your full employer match. Second, consider funding a health savings account if you're eligible. Third, contribute to an IRA, traditional or Roth depending on your situation. Fourth, go back and max out your employer plan further if you're able. Fifth, consider education or other specialized accounts if those goals apply to you. Only after all of that is typically when a regular taxable brokerage account enters the conversation for additional savings. Every year these accounts go unused or underused. You're potentially paying more in taxes than necessary and missing out on years of tax-advantaged growth. None of this requires picking better investments or timing the market. It simply requires knowing these containers exist and using them in a sensible order. Taxes aren't just something that happens once a year when you file. They're something you can plan around every single day through the accounts you choose. If this helped you rethink where your money should go next, subscribe for more videos in this series on taxes and personal finance, and let me know in the comments which account you're going to look into first.